I worked for a company called Quantitative Services Group, or QSG. You might be familiar with that company. We were acquired by Markit about 3 years ago. So we are responsible for the quantitative equity and credit research within Markit, really building up systematic stock selection models, credit factors, stock factors, and really responsible for testing new data sets and internal market data sets to find the application in the alpha space. With that in mind, let me first talk to you guys about the agenda. We're going to first talk about really the state of quantitative investing, where we see quantitative investors focused in terms of data sets, tools which they use, and the kind of strategies that are currently working. Then we'll turn the focus over to some of our more unique data applications, including patent data, commercial real estate property, and social media. And then I'll talk about one of our newest models, our sector rotation model. So the state of quantitative investing, as we see it, we see a lot of the quant funds employing essentially strategies on the same data sets as they have been for the past 10 to 15 years. So we're talking about the common data sets: financial statement data, analyst revisions data, pricing data, short interest, securities lending data. It's obviously a crowded space. And the funny thing about this slide is we've been using a slide like this since 2007. And so really not a lot has changed on the surface in the quant space over the past 10 or so years. But we do see that there's a big possibility for new data sets to be used in the space, and that's really where we've turned our focus over the past 10 years. But the question is, do we really even need to be searching for new data sets? A lot of the traditional models have been working quite well. This is a look at our value momentum model. So it's a model that utilizes a lot of those standard factors that you guys are familiar with. It's a combination of value and momentum, which are really the two key strategies in the traditional quantitative space. And over the past 10 years, this model has worked quite well. It has a healthy return spread of 71 basis points. It's produced positive returns in 60% of the months. And this is in our US large cap space, which theoretically should be where alpha opportunities are the most limited, and it'd be the most difficult to employ a model like this and produce alpha. So do we really need to think about new data sets and look at other sources of alpha? And the answer is obviously yes, because it is a crowded market. You are always looking for that edge in your alpha strategy, and there's always better ways to do things. And so you guys might have a model that looks like this, or be familiar with these kind of models. And I know I've been kind of painting in broad strokes here. We do know a lot of folks out there are utilizing new data sets, such as RavenPack. And I'm going to talk about a few of those data sets which we've focused on over the past few years. First off, why look at new data sets? What are the benefits and the challenges that we see in this space? First off, we've already talked about how do you differentiate in a crowded market? Not only other quant funds out there that are utilizing a lot of the same models, but now you have smart beta funds that are really attaching themselves to the factors that we've all been used to investing on for the past few years. I was at a conference last week around smart beta, and these guys are bragging that they've got a dividend fund that utilizes low volatility, and these are all the strategies which the quantitative fund managers have been utilizing for years. But now smart beta is coming into this space with extremely cheap options. So how do you set yourself apart from those smart beta funds? Another area which we see potential growth is leveraging big data. We've talked about some big data solutions today with RavenPack, for example. But really, there's a big opportunity out there for data sets that are just not publicly available currently to start to become publicly available. As firms recognize the value of some of their internal data sets, they'll look to monetize those data sets. And that's an opportunity for us as quantitative fund managers to come in and extract the alpha out of those data sets. And really the most key benefit we see is adding value to your existing strategies. We're not suggesting that you throw out that value momentum model because it has been working well. But can you find something that pairs up nicely with it, is orthogonal to those signals, and really produces an additive alpha? But as you can suspect, there's a lot of challenges which you face when looking at new data sets. The biggest challenge is just the lack of historical data, the lack of clean data. It's very difficult to trust a lot of the data sources that are out there that have entered the market as potential new sources of alpha because they don't have historical data. Or they do, but it's very dirty and you really can't trust whether the data is point in time or if they've gone back and changed things. And as we've been scouring the universe for new data sets, that's been one of our biggest challenges. In addition, a lot of the new data sets that come out just might not be applicable to your current strategy. I'll talk a little bit about our social media indicators, and I think along the same lines with RavenPack, they tend to be more fast-moving signals that are a bit difficult for some fund managers to implement into their own strategies. So there is data out there, but how do you find it? How do you find the data which is really useful? One of the examples that we have looked at over the past few years is data on patents. So we've partnered with a company called the Patent Board, and they track patent information for any patent that's filed in the US. It's not only information on the number of patents that a company is filing, but it's also information on patents which are citing other patents, which is really the key here because it's a sign of technological strength. We find this to be a very exciting data set because if you think about it, when you're analyzing a technology company or really any intellectual property intensive company, you want to be able to get some insight into their patent portfolio. And obviously you're not going to really be able to do that from the traditional data sources. So we've come up with a suite of factors based on the intellectual property data set. We're looking at things like the growth in patents granted to each company. We're looking at what we call technology relevance and technology quality, which is going back to that idea of looking at the number of patents that are citing a certain company's patent. For example, Apple has its own patent portfolio, and then you have a lot of these other companies making citations to their patents, and that's a real sign that Apple's patent portfolio has something valuable in it. What's exciting for this data set is we found it to be a very additive data set. It pairs up very well with our internal technology model, which is utilizing a lot of those valuation and momentum characteristics. The intellectual property data set is uncorrelated to those factors, and it produces stronger alpha when paired up with it. Another exciting thing about this data set is that it is global. A lot of the new sources of alpha that we found are really US focused or regional focused. The benefit of the patent board is since international companies need to file patents in the US, it allows us to build a global database. For example, Toyota Motors is going to file a lot of patents in the US, so then we can build factors for Toyota and use it in a global model. The next data set we're going to talk about is our REIT property data. So the financials have always been a difficult space for traditional quant factors and models. And about 10 years ago, actually, we started looking in this space for solutions. And we've come up with a REIT model, bank model, and insurance model in the US. I'm going to talk specifically about the REIT model today. It's a very interesting concept. So we're kind of tackling the problem from a bottoms-up perspective. We're taking data from a company called CoStar, which collects information on real estate properties. So they're going to know all the information about a property, such as the year it was built, the year it was renovated, the size of the property, and the location. We can take that information in a systematic framework and combine it with demographics data, for instance, so we can get a sense of whether a company's property portfolio is located in an area with a growing population or a high income population. We then take data from Edgar Online, which collects REIT-specific financial statement data as reported by the companies. We clean that data up, we standardize it to our liking, and then we utilize that to analyze the REIT's company-level cash flow, which we then combine with our factors which we've created on the property portfolio to get a holistic view of the REIT. In addition, we pair that with macroeconomic data to understand the different effects of the macroeconomic regime on different property types. For example, office REITs versus retail REITs, they're going to be affected by different macroeconomic variables. So what we're able to do is with kind of these multiple unique data sets, with really the REIT property data being the key element, we build up a valuation for the REIT, which we then pair up with momentum factors, quality factors, et cetera, into our REIT model. The next data set I'll talk about is a little bit different. Those two data sets were more of a longer-term focused approach to quantitative modeling. And social media indicators fits in much better with the big data topic, which we've been talking about today. We've partnered with a company called Social Market Analytics, who produces sentiment scores on companies based on their Twitter, based on data from Twitter. Let me tell you a little bit about their process and then some information about how the factors perform. The first step in the process is the extractor. It goes to Twitter, the full fire hose of Twitter, pulls in all the data on not just the tweet phrases, but also the person that's posting that tweet. The evaluator is really the key part. It's cleaning up all the data. It's searching through that database of the full Twitter feed, and it's identifying those users which are tweeting that have relevance in the financial space. So are they consistently tweeting about stocks? We're not looking for people that are tweeting, hey, I really like my iPhone 6, the big screen is great. What we're really looking for are people tweeting specifically about stock price movements, earnings estimates, sales estimates, those type of tweets that are going to be impactful to the stock price. After that point, the data gets sent to the calculator where there's a natural language processing dictionary which scores the tweets for sentiment. And the dictionary has been fine-tuned for the financial space, so it can evaluate whether a person is tweeting, I want to buy calls on Apple versus I want to buy puts on Apple. It's smart enough to figure out the difference in sentiment between those two phrases. What we have at the end of the day is sentiment scores for each company. We produce these factors on a daily basis as well as a 1-minute update basis throughout the day. So obviously it's a little bit faster moving than most of the data sets that you might be used to. And we do find that these factors work best in a 1 to 5 day holding period. Excuse me. And but what's really interesting about this data set is that we find low correlation of these factors to other factors in our library that are based on sentiment, such as price momentum, options, volatility, and short interest data. So we think this is a potential new data set to combine with your existing factors. Turning inward to some of the other data sets that Markit owns, one of them that we're looking at right now is called the PMI, or the Purchasing Managers Index. You guys might be familiar with the HSBC China PMI. It's quite a market-moving data item. But let me tell you a little bit about how that data item gets collected. So it's really kind of a big data concept. There are surveys that we as Markit put out to the marketplace, and the survey participants could be from public companies, private companies, et cetera, but they're really key decision makers in the companies that have a pulse on the economic environment, the business environment that their company's in. And what the surveys are trying to capture is what these purchasing managers and executives of the companies feel is the economic outlook for their particular company and their particular sector. So all these surveys go out, it comes into us, and the data gets cleaned, and we produce a score. Basically, a score of 50 means there's no expected economic change. A score greater than 50 means economic expansion is expected. Less than 50 is economic contraction is expected. And what we found with the global PMI value is that it is correlated to equity returns, and it has a leading effect on equity returns by 1 month, which is a really exciting application of the data set. And we'll talk more about other ways which we are currently using the PMI in our sector rotation model. So when we, most of the models that we produce are really stock picking models, stock selection models. But we decided to investigate the ways that which we could use factors in a sector allocation or sector rotation strategy. And the PMI was a big part of that. We knew there's some exciting data in the PMI data set that we want to look at, but we also knew that we were kind of missing that aspect of a strategic allocation, tactical asset allocation in our model set. So we kind of took a step back, looked at our broad factor library, and thought about the different data items that might be useful in a sector rotation strategy. So first off, we have the usual suspects, the financial statement data, fundamental ratios, price momentum, analyst estimates. Then we have the economic data, which is the PMI data. Then we have a few other data sets that are internal to Markit. The first being the CDS data, credit default swap pricing. We've spent a lot of time over the past few years studying the relationship between the equity markets and the credit markets. And we found this to be a key element to include in the model. Another securities finance data. You guys might be familiar with Markit Securities Finance Data, formerly called Data Explorers. It's really a good way to get insight into a proxy for the short interest market and understand how negative sentiment is affecting stocks. We use that in the model as well. And then we use some data from the ETF market. And what's interesting here is we found really a reverse method of utilizing the ETF flow data. So it's a contrarian indicator. And we really think that's because a lot of the retail flow is coming through ETFs, and they're kind of behind the curve. They're not betting on the right sectors. Let me talk a little bit more about the PMI data and how we're utilizing it in sector rotation. So you have the global PMI data, which is a combination of all the surveys, but you can disaggregate that value out into different sectors or different countries. And what we've done here is disaggregate it out into sectors within developed Europe. We chose developed Europe because we have the longest history of data in the developed Europe space. Not only can you disaggregate the overall scores, but you can also look at different metrics that the PMI is tracking. For instance, we have metrics that include changes in the levels of output, changes in the input prices, unemployment changes, And what we've done is we've looked at those variables in isolation to really get a sense of what's a good predictor of equity performance. So with all those data sets in mind, this is the construction of our sector rotation model. So it's 4 components, the first being the economic module, which utilizes that sector PMI information. And really what we're trying to do there with the sector PMI is look at abnormal changes in sector PMI levels. So we recognize there's going to always be kind of differences in the ways that different sectors view backlogs and orders. So what we're looking at is over the past 3 years, is a specific sector forecasting greater performance or worse performance on these particular metrics. The sentiment model is where we bring in that CDS data, ETF flow data, and market securities finance data. One thing to note here is that the securities finance data, we're utilizing it in more of a conditional tail-focused framework. So we're not looking at a cross-section of indicators. What we're looking for is particular negative sentiment in sectors. Then we have the momentum module and the fundamentals module, which is where we bring in some of those traditional factors that are in our standard models. And what's interesting here is we kind of took a step back from our standard factors and didn't just blindly roll them up to the sector level, but we thought about different ways that we could apply these concepts at the sector level. For instance, earnings revisions. There's a common factor called net number of revisions. And so what we did was we took that concept to the sector level. What's the net number of revisions within each sector, up versus down, and use that as our indicator. And the fundamentals module is looking at return on assets and profit margin. What's interesting here is that the traditional valuation factors, we did not find them to be very strong predictors of return. Whereas these more qualitative factors, measures of quality, they were strong performers as long as you're looking at a sector's trend over time and looking for those cases where a sector is either abnormally high or low relative to its recent time period. So here's a look at model performance. Our in-sample period is from 1999 to 2012, and then the out-of-sample is 2013 through October 2014 here. This is a European model. In the developed markets, essentially we build sector returns for each of the 10 economic sectors, their market cap weighted returns, and then we select the best 2 or 3 sectors as our favorable bucket, and the worst 2 or 3 sectors is our unfavorable bucket. And then we go long the favorable names, short the unfavorable names. This price trend is over the 3-month time horizon, time series data. As you can see, the model's not perfect. It is a difficult thing to do, predicting sector performance. But we do find pretty strong returns with minimal drawdown periods. Looking at the table below, we break out the performance of each of the individual modules, as well as the model composite. We do see an additive benefit of having these diversifying signals within the model, where the model composite has stronger results than any of the individual components. But what's interesting too is you can see some of the individual components have stronger performance in different time periods. The economic module, for instance, has its strong time horizon is the 1-month time horizon, whereas the sentiment module actually has better performance over the 12-month time horizon. We also have the hit rates on the bottom right-hand side of the table. And this is the percentage of months where the favorable bucket beats the unfavorable bucket. And overall, for the model composite, it's pretty compelling results, over 60% on a 1-month time horizon and over 73% on a 12-month time horizon. So in conclusion, as we are building models and working with our clients in the quant space, we find that there is an opportunity to leverage new data sets in conjunction with those traditional data sets that most quants are utilizing. And I think something like the RavenPack data is an example of where you might find the opportunity to do that. But the challenge is, how do you find the right data sets? How do you find the clean data sets? And that's what we spend a lot of our time doing, going through new data sets, testing them out, really verifying whether the data is useful or not in the quant space. And then finally, the sector rotation model is our example of how to bring those data sets together, the traditional and the new data sets, and use it in a pretty unique framework.
Excellent. Thank you, Chris. So we're going to open up for a couple of questions. I know we're running a little bit behind, so would you mind passing me the mic? Thank you.
Hi. You mentioned that in the sector model, specifically for the sentiment model, you use it for tail. Is it tail hedging? Can you expand on that?
Yeah, excuse me. So that was one of the factors in particular we're using just to penalize sectors that score poorly on what we call our lending supply factor, which is utilizing our securities finance data. So the securities finance data, it's sourced from the securities lending desks. And we have this factor called lending supply, which really is a measure of the participation of those lending desks in the securities lending market. And what we found is that there's a pretty strong negative signal in the one tail, but not a real strong positive signal in the other tail of that factor.
Okay, one more question. Okay, Chris, thank you very much.